All right, people, good morning. Good morning, DeFi House community. Happy Monday. This week is a busy week in terms of content updates because I do have a very long list of stuff to do in a community, and it's just, step by step. As more people join, as more people start watching the content, asking questions, everything, the more feedback I get and other team members, the better. So if you have any questions, suggestions, anything in regards to the platform, please let me know, because it's really, really important to us. This is, from my perspective, that's my passion. That's what I do. I, I just like to speak, share my stuff. So that's what I do. And it's really awesome to see people appreciating that as well. So in this video, I want to go ahead and cover the understanding of different fee tiers in DeFi pools, because that is also very, very misunderstood thing. A lot of people, both from the trading perspective when they want to swap in between two assets, and both from liquidity provision from DeFi perspective, they tend to misunderstand and see the differences and importance of this thing. So basically, not all the pools are the same. Most people are looking only at the volume and the TVL of the pool. So you come to Orca, to Aerodrome, Uniswap, VFAT, doesn't matter, any DEX, right? And you are looking to find a pool to provide liquidity into, right? So in most cases, people, they will go to, let's see, for example, on Orca, right? You go to Orca, you will see the pool, Solana USDC. You will see that, good volume, 144 mils a day, a good TVL, 54 pretty much millions. And it's like, oh yeah, that's a good pool, and you will deploy capital into this pool. On Orca, this is, the only pool that you can deploy when it comes to Sol USDC, but it's not the same case among other chains, etc. So this is good enough. If you are focused on high volume and TVL, this is already good enough. But there is a third option, a third scenario, actually four, but in this one I'm covering the third one, the fee tier. So when you just have a native simple DeFi pools, you have two main options, right? The higher the TVL, the more confidence you can have that the DEX itself, the pool itself, is going to be stable. It's going to be, okay. When you have some sort of a new DEX and you have a good pool, let's say ETH USDC or SU USDC, doesn't matter, but you have just a TVL of, I don't know, 1 million, even less than that, or 5 million, etc., which is not that much in comparison to the general DeFi sector. In this case, if you have a small TVL and the protocol is like so-so, it's a pretty new one, it's a pretty buggy or laggy or whatever, then it's best not to deploy capital. It's best to go ahead and sacrifice some returns, accept the idea of lower returns, and simply deploy capital to a better pools with higher TVL, right? And the second option is, the higher the volume, the more fees people are paying. So the volume is the most critical thing you can do, right? Sorry for notifications. So basically, the higher the volume, the more fees people are paying. So you want to be looking at these two things, and in most cases, you want to have much higher volume in comparison to TVL. So if the TVL of the pool is like 50 million and the volume is towards hundreds of millions, like 100, 150, 200 million, then it's a very good ratio, meaning that the pool is fairly nicely concentrated, and people are trading, people are swapping in between those two assets, and the volume is much higher than the TVL, which leads to more fees being distributed to the liquidity providers, people like me and you right now, okay? But there is a third thing, and the third thing is the fee tier, because it's basically, the fee tier stands for the fee that traders are paying to swap, right? So this does not involve and affect us as liquidity providers, but we always have options in what kind of fee tier pool to provide liquidity to, okay? So for example, these are the 3 different pools, and I just showed you Solana, Sol USDC, and this number next to the pool is the fee tier. So this means that 0.04% is the fee for each transaction, for each swap on this pool. So when traders are buying and selling Solanas or USDCs, right, they're paying this 0.04% per transaction, and then all of the fees that the pool generates are being distributed among people like me and you, okay? And then we have 2 examples of the same assets but 2 different fee tiers. For example, right here we have ETH USDC on Airdrome with 0.05% fee tier, and then we have ETH USDC pool on Uniswap with 0.3%, which is way higher, way higher, right? 0.3 and 0.05 is 3 times, more than 3 times higher fee tier, right? And these 2 pools, even though they are the same in terms of the assets, you have ETH and USDC, and you have usually even the same chain, both of these pools are on base chain, just at different dexes. But even in that case, you can find on Uniswap the same chain, the same assets, but multiple fee tiers. So for example, you can find the same ETH USDC on Uniswap with 0.3, the same pool with a 0.05 fee tier as well. So then you have this natural question pops up, right? Why would someone pay a higher fee to trade? And the most simple and basic answer is slippage. When you have big capitals, and this affects mostly when people are swapping big amounts of money. This starts from between 50K towards millions, right? Because, well, the majority of people that are being involved in DeFi, especially in the blue chip assets, they are swapping higher amounts. You would be surprised to see that those small, tiny amounts is even not the majority in most cases. In most cases, the majority of transactions on these pools are big amounts of money, from 50, 100K, $500,000 up to $1 million, 2, even 3, etc., right? So when you have a small fee tier pool, meaning that a lot of people are constantly trading that pool, right? The slippage is a really important thing, because on a centralized exchanges, when you have a really tight and strong order books, this is not that much of a problem, right? You can get filled in most cases without any slippage, or a very, very minimal slippage, and even if you have very big capitals, you can go through the OTCs, or there's dark pools, etc., and get 0 slippage at all. But on DeFi, on decentralized matter, decentralized exchanges, when you are swapping the assets, especially higher amounts, the slippage is a thing. And the slippage itself is basically a thing where, for example, you go to your wallet, you click on swap, and you want to swap between Solanas and USDCs, and it's going to calculate you the route. Let's say it's going to be using Orca Sol USDC pool to swap, or you swap specifically on Orca. By the time it calculates the best possible price, and by the time you click on swap and confirm the transaction, any changes in that pool will affect your value that you receive as well. So this is known as slippage. You could be actually swapping exactly 10K, but you can get less or even a bit more depending on the slippage situation and the price movement at that specific time. But basically, people that want to swap higher amounts of money are usually choosing higher fee tier pools. And this is because in some cases, if they swap on a lower fee tier pool, let's say 0.05%, the slippage that they get on $500,000 worth of transaction will most likely be much higher than 0.3%, right? So that's why they tend to go, they just cut the possibility of higher slippage and they go straight to the higher fee tier pool, like this one, with 0.3% fee. And in most cases, these pools will have less TVL, less volume as well, but the transactions will go the transaction will go through much smoother. And in that case, they will get usually less slippage. This is like the only thing, one of the most common things, why would someone pay higher fee? Just to get out of the position quicker, because those pools are not so overcrowded. So you pay more, but you get out quicker and smoother. So there is less risk of transaction error, there is less risk of higher slippage, etc. It's just like you can say this as a premium, way to trade, like a VIP position, so to speak, right? You have a $2 million in USDC, you want to buy some ETH or Solana. You can have two ways. You can stand in line with everyone and just try to get the best price possible, or you can say, I'm flying business class, I'm going to the premium fee tier pool, I will pay higher fee, but I will minimize my chances to get a higher slippage or to get stuck in queue or to get any transaction errors. So when it comes to DeFi and liquidity provision, we as traders, oh my God, not traders, we as liquidity providers, we have to also think and check, most importantly check, what kind of volumes and fees higher fee tier pools generate, because sometimes you will be surprised that with way less volume, these pools are making way higher fees in terms of the standard pool right here with 0.05 that everybody is using. So sometimes it makes sense to deploy capital into the pools with higher fee tier, even though the volumes are lower in comparison to the majority of the pools. With, let's say, this one, the volumes for this will be lower, but the fees generated in most cases will be higher, meaning that people are paying more fee per trade, which also means there is a higher average trade per customer. In that case, it just also makes sense to deploy capital into that pool, because you will get better returns as liquidity provider as well. So this is the core principle, the core understanding of the importance of the fee tier. So now we can jump to the VFAD. I can show you one example, which is, it's a pretty good example. It's not the best, because the average DEX volumes these days, when the market is a bit messy, are not the highest, but still, for example, if you go to the pools, not the farms, I will explain the difference between farms and pools on the next video as well. But basically, if you go to the pools, it means that you are basically just getting to the standard pool where you get the fees from the trading. So for example, you have the you have the same pools, if USDC, if USDC, if USDC. These two are on Uniswap, right? On Uniswap. One is 0.05, one is 0.3. In this case, 0.05 is doing more fees over the last 7 days than the higher fee, meaning that there are not much demand for very high amounts of money to be transacted, which also means less fees, but still it's pretty good in comparison to 0.05, because it's either gonna be a massive difference where this pool outperforms this one massively, and I speak 5 times at least, or it's gonna be where this pool 0.3 outperforms the cheaper one, but not by that much, but still outperforms. So in this case, it's a pretty standard, meaning that most people swapping are using cheaper pool. because in most cases the average a transaction size is not that high. But if you compare on Aerodrome, just the pool, not the farm, as you can see, even though the TVL is the highest in Aerodrome on this pool, the fees generated is only 86K over the last 7 days on average, in comparison to Uniswap, where it's the same fee tier, way pretty much 2 times less TVL, but more than 2 times in fees, right? So the volume in this pool is much higher. So it would make sense to deploy capital into this pool because you are getting more from your money, you're getting higher returns. Of course, on IRO, in most cases, people are using IRO emissions as rewards rather than direct fees from the trades, but still, it doesn't matter. What matters is where you can get the most out of your money. And in this case, this pool on Uniswap would give you the best returns because they are generating pretty much the most fees, right? The most fees. And you can always scroll and see the rest of the pools on other places as well. But the highest ones are definitely these ones. And you can choose between different chains as well, right? Different chains as well, and you can find a lot of different opportunities. For example, very also interesting factor to know. So we have the pool, this one on Aerodrome, sorry, on Uniswap, ETH USDC, right? This one on base with 26 million TVL, 200K in fees over the last 7 days, more or less. That's the average. But then you have the same assets on Arbitrum with higher TVL and even more fees, right? Even more fees on Arbitrum. So that's also a very important thing to understand, that even though you have the same assets, if those same assets are available across multi-chains, then you must check across different blockchains to find the best opportunity to deploy capital into. But I mean, in most cases, when it comes to ETH, I use either Base or Arbitrum. It's the best chains in terms of volume right now. They also have this one, which is the Uniswap native chain, I believe. Uniswap, or this is version 4, I'm not entirely sure. Because Uniswap, they have the kind of their own L1 right now. But yeah, I mean, if you don't care about the chain and you only care about the returns, then you could get a fairly decent returns on Arbitrum right now. But also keep in mind that which chain is better performing over the longer perspective, because sometimes there are liquidity and volume spikes in certain chains like Arbitrum, but Base is better for a long-term perspective. So this is also a factor. You cannot just blindly jump that, oh look, this is 0.05 tier, highest TVL, highest fees, I'm going in. Because these fees might be high because something happened on chain, something happened where a lot of liquidity and volume were spiked and inserted. But over the longer term perspective, this pool, for example, generates still better returns over time. So these are all of the things to consider and understand when it comes to fee tier and pool selection. So hopefully this video is beneficial, will help you make better decisions when allocating capital into the DeFi pool. So once again, thank you. Have a fantastic week ahead, and I will see you on the next video.